Every year, professional fund managers, people with Ivy League degrees, Bloomberg terminals, and teams of analysts lose to a strategy so simple a 10-year-old could understand it. We're not talking about a few managers. We're talking about over 90% of them, consistently, year after year, decade after decade. And the strategy that beats them, it takes about 10 minutes to set up, and then you never touch it again. Today, I'm going to show you exactly what it is, why it works, and how to use it to build real wealth. Even if you've never invested a single dollar in your life, here's exactly what we're covering today. What index funds actually are. In plain English, why they outperform nearly every active investor and fund manager. The exact funds Warren Buffett recommends, and why. And the step-by-step plan to start using this strategy today. Let's get into it. Let's start with the basics. What actually is an index fund? Imagine you walked into a shop and instead of buying one stock, one company, you could buy a tiny piece of every major company in America, all in a single purchase. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Berkshire Hathaway, all of them at once. That is what an index fund is. It tracks an index, like the S&P 500, which is simply a list of the 500 largest companies in the United States. When you buy an S&P 500 index fund, your investment rises and falls with the performance of those 500 companies combined. If America's economy grows over time, and historically it always has, your investment grows. There's no fund manager picking stocks, no guesswork, no expensive research teams. The fund just automatically holds everything in the index. That simplicity is not a weakness. It is its greatest strength. Now here's where it gets interesting. If index funds are so simple, why do they beat the professionals? 3 reasons. Reason 1, fees destroy returns. Actively managed funds charge you 1% to 2% per year in management fees. That sounds small, but over 30 years, a 1.5% annual fee on a $10,000 investment costs you over $30,000 in lost growth. Index funds charge as little as 0.03%, practically nothing. Reason 2, nobody can consistently predict the market. Study after study shows that even the best fund managers cannot reliably beat the market year after year. In any given year, some get lucky. Over a decade, almost none of them maintain it. Meanwhile, the index just quietly tracks everything and keeps going up. Reason 3, time in the market beats timing the market. Active investors constantly buy and sell trying to catch the perfect moment. But the data is ruthless. Missing just the 10 best days in the stock market over a 20-year period cuts your returns in half. Index fund investors stay invested through everything. They never miss those days. You might be wondering, if this is so obvious, why don't more people do it? The honest answer is that the financial industry makes more money when you don't do it. Active funds, financial advisors, trading platforms, they all profit from your activity. An index fund investor who buys once and holds forever is their worst customer. But here's who recommends index funds. Warren Buffett, the most successful investor in history, has publicly stated that for most people, a low-cost S&P 500 index fund is the best investment they can make. He even bet $1 million against a hedge fund that an S&P 500 index fund would outperform their hand-picked portfolio over 10 years. He won, easily. When the greatest investor alive tells you what to do with your money, that's worth paying attention to. All right, so which index funds should you actually buy? Let me give you the short list. VOO, Vanguard S and P500 ETF, tracks the 500 largest U.S. companies. Fee, 0.03% per year. This is the gold standard for beginner investors and what Buffett specifically recommends. VTI, Vanguard Total Stock Market ETF, holds over 3,500 U.S. companies, small, medium, and large. More diversification than VOO. Fee, 0.03% per year. VXUS, Vanguard Total International Stock ETF. If you want global exposure beyond the U.S. Fee, 0.07% per year. For most beginners, VOO alone is all you need. Buy it, hold it, add to it every month. That's the entire strategy. You can purchase any of these through Fidelity, Vanguard, Charles Schwab, or Robinhood. All free to open, no minimum balance on most platforms. Let me say this clearly. You do not need to be smart to beat 90% of investors. You do not need to watch the market every day. You do not need an expensive advisor or a complicated strategy. You need one thing: the discipline to start, stay consistent, and leave it alone. Open an account. Buy VOO. Set up automatic monthly contributions. Repeat for 20 years. That's it. That's the strategy that beats the hedge funds, the analysts, and the experts. If this video helped you see investing differently, hit the like button and subscribe. Every week we break down another money strategy that the average person was never taught. Drop a comment below. Are you already investing in index funds, or is this your first time hearing about them? Your money, your future, your rise.